Welcome back to the Stablecoin Podcast. We're your hosts, Luther Madej and Rami Suleiman. We're co-founders of the Stablecoin Partners. Our guest today is Geetha Panchapakesan, founder and CEO of Tesser, a company building stablecoin-based payment infrastructure for enterprises, banks, and payment service providers. Geetha has spent her career at institutions such as MoneyGram, Visa, and Circle. Today, she's applying those lessons to building modern payment rails designed to move value faster with less friction and without the capital inefficiencies of traditional correspondent banking. This conversation is about what stablecoins actually fix and where enterprises still struggle to adopt them. Before we get started, a quick disclaimer. The opinions expressed in this episode are those of the hosts and the guests and do not represent the views of their employers or affiliated organizations. This conversation is for educational purposes only and should not be taken as legal, financial, or investment advice. With that, Geetha, it's such a pleasure having you on the show.
I'm so thrilled to be here. Thank you so much for having me. I don't know, Luther, how long have we known each other? I don't think it's been that long. It's been a few years, but it feels like forever.
It does feel like forever because it's a deep friendship. That's what it is. As we get started, Geetha, you and I have a similar background. We started at MoneyGram. We moved on to different places, and then we kind of got into digital assets. What are some of those pain points that you felt at places like MoneyGram that told you that digital assets is the way to go?
Yeah, it's a very good question and a very kind of long one to answer. So I will do my best. But overall, I would say that I started my payments career at MasterCard, where we were just doing prepaid cards, and prepaid cards was like it was like there was this whole financial inclusion aspect to it, which was like great, and which is why MoneyGram was kind of an automatic next step, because here we're bringing people into modern payment methods and the next billion customers, things like that. And at MoneyGram, it was where I first saw not that easy to do that. If you're sending money from the US to any other part of the world, and generally most remittances, as you know, Luther, do flow western to eastern, north to south. And the north part generally tends to be easier, the south part not so much. And in order to actually allow MoneyGram to help their customers move money as quickly as possible, there were many things that had to happen. There was capital that had to sit in various places so that when a message is sent to pay out to somebody in Mexico, that they are able to be paid out right away. Or someone had to take a risk, like somebody locally makes a payout and then like hopes and prays that they actually get paid back afterwards. So that process at MoneyGram, which MoneyGram was deep into, that is how they did their business, was a very, very interesting one. To get one partner live in the Philippines took 8 months because the negotiation of how much we need to keep and what they might give us, actually they gave us nothing, and what it might cost to move the money, all of that ended up taking so long, which ultimately affects the people that need to move money home because they need to move money home as quickly as they can. So working capital needs, credit. I mean, you can move money at your own time. Like you can wait for funds to move from Brazil to the US to Singapore to Malaysia. And by the time that whole thing happens, it can take like a good few weeks. Okay, at least a few days. But if you really want it to be efficient and you want it to move faster, there are people in the system that bear the costs and take the risks. And so ultimately, money movement across the globe is a very, very, very difficult thing.
What is the most inefficient part in all that? Like, what is the biggest pain point that fintechs and PSPs have from this whole movement and pre-funding, as we call it?
It's working capital. It's money you could be using for something else. Instead, what are you doing? You have to park funds in India, in Mexico, in the Philippines, and wherever you're moving money to, you take out of your balance sheet and you park the funds, or you have to have your customers actually pay it, which in a remittance scenario is not doable, but maybe in an enterprise scenario it actually is. But then that cost adds up, right? So ultimately, it becomes both expensive and does not allow you to do other things you could do with that money on your balance sheet. So it is a fundamental pain point.
the FX hedging that one has to do in that
Yeah,
space is
exactly.
also
That's exactly right.
crazy, because you're guessing, you're creating a balance in a foreign currency based on your guess on how much movement is going to happen 2 days from now on a
Right.
weekend. You know,
Right. And
it's
you know
that.
this because you've been through the exact pain at MoneyGram. Yeah.
So from there, you came to Tesser, to the founding of Tesser. It's been a long journey. Where does Tesser actually fit into this whole ecosystem now?
No, I was in cross-border payments like post MoneyGram. I headed up cross-border for Visa Direct. I was doing some level of cross-border work, in between for like startups as well. So having done as much cross-border as I did, I knew that cross-border fundamentally was a difficult thing to solve for. I was actually part of the US Faster Payments Council. I was the rep from Visa, and like, oh my God, that was crazy, because nothing ever really could be solved for. And yeah. And so when Circle happened, and I heard Circle was a thing, and I heard about USDC, and I heard about blockchain, I was like, all right, this sounds brilliant. And I'm going to Circle so that I'm going to now be part of this new infrastructure and tech, and I'm going to learn everything about it that I can, and we're going to solve everything cross-border. It was a weird 4 years at Circle because, the market went up, the market went down. So, stablecoins in 21, when I joined, stablecoins were starting to become real and mainstream, and the large PSPs were starting to look at it and go, all right, this makes sense. I actually think I could use this to reduce my pre-funding, to settle instantly with my merchants who can get paid out right away, and all those good things. But lots of things happened, starting with FTX, going through a few other things, the banking crisis, and it didn't quite take off the way it did. But end of 24, when Stripe bought Bridge, all of the jurisdictions were starting to look at regulation. Actually, many of them had already done. I think by then we had Singapore, we had Euro, we had UAE, and so there was definitely by that time a realization that the technology makes sense. The whole thing is that it actually solves real problems, and now it's just a question of how do you incorporate it into your existing systems, capabilities, etc. And that's where I was like, all right, like if all these banks and PSPs have to start incorporating stablecoins, at least that's a clear kind of belief that I have, that they would need the infrastructure to do it. And in order to get the infrastructure to do it, I formed Tesser. You could go to like a third-party PSP who moves stablecoins for you. You could give them your money and they would move it. That would be similar to Bridge and Conduit and BBNK. But my hypothesis was that every bank, every PSP wants to control their risk. They have their own obligations as well, both from a risk perspective and a customer perspective. When you hand your money to someone else, it becomes their obligation, not yours. You're not able to manage the risk the way you want to manage it, report to auditors the way you need to report it, and then provide the level of data, because these guys today are doing both fiat payments and stablecoin payments. And you need to be able to say, okay, Google, I'm moving money for you. I need to be able to tell you all the money I've moved, how much it cost, what the fees were, what the FX was for every single thing. How do you get that level of data if you hand your money over to a third-party provider? So my hypothesis going in was that this is a stack that every bank and PSP will need, because they need to control the flow. They need to control the movement of funds themselves. And that's fundamentally where Tesser came up. It's a white label technology stack for FIs, for banks and PSPs to be able to move money on behalf of others.
Banks and FIs often struggle to adopt new technology. Part of that is because they want to own the stack, but then owning the stack means hiring a multitude of people, and they often hire way more than a startup or a smaller company would. How does Tesser kind of solve that problem for them?
You just answered the question. It's exactly why. Is that banks can do this. They can build this themselves, and you've seen that happen. They've announced things. The truth of the matter is you have to go hire 10 blockchain engineers. You have to figure out, all right, am I doing USDC, USDT? Am I doing my own stablecoin? Am I doing, PYUSD? Now, do I do Solana, Polygon? Like which chains? Oh, wait, there's a new one. It's called ARC. So this constant, what do they need to build? How do they need to keep up? How do they need to evolve with it? And how do they think about like very core at the core? How do you hold the funds? What kind of wallet do I need? Do I need MPC? Do I need TEE? Do I need a third party? Like, how do I actually do it? So all those things, we completely abstract the complexity away from the FI. And we're like, listen, all you need to do is plug into our APIs. You can even not even do that, just use our dashboard. But you plug into our APIs and you're able to actually send, initiate stablecoin payments. We're also connected to off-ramps, etc. So you can also do the stablecoin sandwich, which many people do not like the term. But you can do all kinds of payments using stablecoins if you just plug into this stack rather than you having to build the whole thing yourself, and constantly evolve. Because as you know, it's still a very fragmented space. It's still a very, evolving space from a technology perspective. So why keep up with all that? Like, we have that.
Even though people don't like stablecoin sandwich, I still like it better than the DeFi mullet. The DeFi mullet was one that one was for hard for me to kind of digest.
Although I would say your hairstyle at the moment is looking a bit DeFi mullet, to be honest.
Yeah,
actually.
I could be.
It's very,
for those
very
who are
stylish.
just
I haven't had a chance to comment on it today, but yeah, it looks
this may be the reason why people switch from listening to the podcast to watching the podcast.
This is the inflection point, huh?
This is the inflection point, for sure.
This is the point. No, it's fascinating listening to this. I think you really, there's a great product market fit here, and you're absolutely right. I mean, we've all actually had history of working within banks and fragmented IT teams and skunk work, blockworks, blockchain projects that actually don't do anything. And yeah, you're right. Now it seems post 24, 25, there's a commitment to actually do something within these FIs now. They've got the confidence and the regulatory clarity that they need to move forward. But that doesn't mean that they're in any way, shape or form subject matter experts on this stuff, and it's moving way too quick. So I think being able to abstract that out to a third party makes a lot of sense. I wanted to check in terms of, because the thesis makes perfect sense to me. I get it. What's been the take-up of the FIs and the PSPs so far? Have they been open to this proposition? Have there been any themes globally? Are there particular regions that are more interested in this than others, or other areas that you seem more progressive? We met in UAE, and UAE is certainly one of the more forward-thinking, stablecoin-oriented regions that are out there, but obviously Singapore and the US is now doing a lot of stuff as well. So what are your themes from your world travels on this project?
Yeah, that's a very, very good question. The truth of the matter is, at least what I see is that cross-border money movement is where the product market fit is. And even within that, I think you have to have emerging markets on one or both sides of the transaction. That's where you're actually going to see true value. Because otherwise, if I sit down with Frost Bank or Webster Bank, and they're like, where do I look for ROI? I don't have an answer for them. I'm sure other listeners of yours probably do, but I genuinely do not. So what I've been doing very much is focusing on emerging markets. So we spend a lot of time in LATAM. We are spending time in other markets, but trying to at least get a foothold in one market, which is primarily in and around LATAM. And what we're seeing is, so look, when you think about sending stablecoin payments, that's one piece of it, which is, okay, you have the stack now, you can now initiate stablecoin payments, you can do it for your customers, or you can do the stablecoin sandwich. There is a flip side to it, which is that this is our like, we're big believers in this, which is that in the emerging markets today, like for stablecoins to proliferate, you need good off-ramps. And the existing off-ramps are pretty much all crypto exchanges and crypto as a service providers. And on the send side, the banks are not jumping in because they don't necessarily trust the receiving party. So what we are trying to do is actually talk to a lot of receive side banks to say you should become off-ramps in the local market. Now, depending on the market, to the point that you made, Rami, about like regulation and, how people feel about it, depending on the market, they move faster or they don't. No bank moves fast. That's a given. But, in terms of like specifically this, how quickly they want to get into it, we have a lot of conversations going. But, I think it will just take the time it takes to get there. PSPs, on the other hand, are moving a lot faster. I'll tell you the other interesting kind of dynamic that I've seen for PSPs, which is that 4 or 5 months ago, when I started this conversation with a bunch of PSPs, the large global ones, they were like, we have a relationship with BVNK, we have a Circle account, like we're good. And now they're all coming back to the table and they're like, you know what? Why am I giving money away to a stablecoin provider? I would like to own the entire stack. I would like to provide everything. I'd like to provide payouts in fiat, payouts in stablecoin, pay-ins in fiat, pay-ins in stablecoin. I want to do all of it. So we're starting those conversations as well. And this is pretty much like many of the large ones. So I do think the market is still evolving, Rami. So I'm not giving you like a single answer. I think emerging market banks, receive side, I think there's a lot of opportunity. We're trying to push that. Global PSPs, fundamental infrastructure opportunity. We're trying to work with that as well. And then my first couple of customers are actually, interestingly, folks in the US who provide US dollar bank accounts to foreigners. So if you need to get paid in US dollars or pay out in US dollars, you open an account with them. They usually are like a virtual account FPO model. And then now they're like, wait, I can also do stablecoins. Can you give me the stack for it? So great, Mike. So we've kind of married the virtual account and the stablecoin stack, and you now have kind of the end to end. So those are the different things that I'm seeing. And that's where we are focused overall. But listen, if you have something in the UAE for me, Rami, I'll be there. Just let me know.
There's always something in the UAE. No, it's great. But that's super interesting. And I think what's most interesting is there's obviously we've reached an inflection point within these financial institutions where they've realized there's money to be made and it's a serious growth opportunity, at which point they want to control the economics. And that I think that's the switch. That's the switch at the moment. The moment is sort of, it's an add-on and it's fine. We'll work with a third-party vendor. We'll use a BVNK and a Circle and we'll fix it whilst we have initial customer demand. But it's clear that there's a long-term proposition here, that they think that there's going to be a client proposition, and now it's the time to make it serious, bring it all in house, own it, and so on. So it's great that that's starting to happen within FIs, and we've seen it. And to your point actually about the proposition around pitching receipt banks to be the receivers of the stablecoin receipt, and it's similar to a thesis we heard from Tony from Ubix. He kept saying, you need to be, it's like, what was it, Pokemon? I think it was. You need to catch them. You need to catch these stablecoins, catch them in your financial ecosystem, get the stablecoins into a bank account, and that's the way to sort of legitimize them, or at least administrate them in a sensible way. So it's interesting that we're getting this convergence and we're getting this maturation of how to build it as a product within the bank. It's not sort of just an add-on. It's now becoming core product, which is very encouraging.
Yeah.
Tech stack is one thing. Geetha, what are some of the pushbacks you get from the regulatory side?
They fall into, I think, two broad categories. The first category is part regulatory, part not. So category one is generally the tech stack. So we built the stack as we won't be in the flow of funds. We're orchestrating the money movement. We're providing self-custody wallets to the FRs. The self-custody wallet is something that we have run into a little bit of, like, people are like, one, I have to figure out if I'm now holding these funds on behalf of my clients, how do I manage it, like, from a compliance perspective and also from a security perspective, right? Okay, what if I get hacked? Like, it's still new technology for them. So they've been looking to have providers that are either third-party custodians, which is where, we're wondering if maybe we need to kind of add ourselves to that list. But that seems to be one piece, which is holding customer funds in stablecoins. They're not exactly sure. Apart from that, on a jurisdictional basis, there are many jurisdictions, especially in LATAM, it's gray. Like, Mexico hasn't said, don't do it, do it. Like, it's somewhere like in the middle. So what happens is there are those banks that are willing to jump in and, they find ways around it. And they're like, I will ask for forgiveness later. But most of them are still very slow. So in Mexico, I'm talking to more PSPs. I am talking to banks, but I am talking to banks and I'm talking to banks and I'm talking to banks. And I don't know how much longer that'll take. But that's how that seems to be. They're just afraid to pull the trigger just yet. But then in jurisdictions like Brazil, where it's a lot clearer what they need to do and what the requirements are, at least people know what those limits are and they're willing to get into it. But yeah, that seems to be kind of the thing. But to be honest, PSPs are not so concerned. PSPs are a lot easier to work with in that way. Banks are very concerned.
It is interesting to your point, because in Mexico, we've had friends at Banco Azteca who are very digital asset forward, and then banks and other places not being as digital asset forward. Is it the same kind of pushback from compliance teams within the banks or PSPs even?
What's happening with the compliance teams actually is that they're like, all right, can you sit with me and explain this stuff to me, please? So we do a lot of that. Like we've actually sat down with compliance teams of at least 3 prospects so far, and walked through what this means, how does it look, and ultimately they have all 3 of them, it just so happens, have said we would prefer to go with a third party custodian because then I know that they're handling the licensing kind of elements of it and I don't need to worry about it. For now, once we get used to it, I will take the next step. That's how people have been approaching it.
So it's basically offsetting the liability from that perspective.
Exactly right.
Yeah, a bank needs someone to sue.
You talked about constantly explaining this. What is this? Like, what is the thing that you're constantly explaining to various compliance teams often? Is it the flows? Is it the definition of what this means? Like, how basic or how deep do you get in?
No, I mean, like they come at you with very basic questions like, I read this thing, so much AML. How do you know where this USDC is coming from, where it's going?
Silk Road. It's all Silk Road.
It's all Silk Road. Exactly. Exactly. And so that's one of the primary areas that actually we have to get through. And actually, when I sit down and show them, because our stack also includes the compliance piece of it, we do the wallet screening and the transaction monitoring. And when we show them that there are 152 elements that go into the wallet screening and the transaction monitoring, like, oh, I didn't realize you could do all this. I didn't realize you could get this level of control. In fact, in certain ways, you get more control than you get in fiat because the stuff is out there for people to see. So you can figure out exactly what is going on. How many, if I'm sending to a wallet that, has interacted with an OFAC sanctioned wallet 5 hops away, I know that, right? And so I can decide, is that too risky for me? Is that not that risky, right? So when I show them all of that and get to that level of detail, they actually start wrapping their minds around it. But the other area also is, like I said, it's like what happens if I get hacked, which is less a compliance issue and more a security issue, but it's a new thing for them. And like, oh, I'm holding my own private keys. I don't know what that means. So kind of getting them over that hump is also work.
Yeah. I think they're generally surprised with the level of transparency of such a product. I think because the hype and the noise and everything they've heard is that it's, as you say, it's illicit activity, it's all criminals, and they use it to obfuscate things. But then when you show them, transaction monitoring systems, that like we used to use a GMO, are fantastic. Again, you can see 5 hops down and more. You can see all the interactions. It's much more, much more safe for them to use the system in terms from a data analytics point of view than actually tracing the cash that they have to cover in their current methodology. And then it's also ironic because you name the bank that's interested in blockchain, I'll name you a AML fine that they've paid for money.
That's exactly right. I'm like, people like, oh, did you see that thing about Contigo? Like, oh my God. And I'm like, seriously, like how many, like, does AML, do AML issues never happen in fiat? But like, seriously, like, so, I don't know. I do say that it's evolving and we'll get to like much tighter controls, but we already are, quite there. So
it is a double-edged sword, right? At MoneyGram, when we implemented cash on and off ramping with Stellar, it was n number of hops. So it was unlimited hops. And so I was asked to shut down wallets by their chief risk officer that had something that came from a wallet that was 60 or 80 hops ago.
Oh, wow.
And I was like, you would never be able to do this. And you're punishing me for something that you would have never been able to do just because you can see it. And his argument was, well, once I've seen it, I can't unsee it, right?
But he's got to take a risk-based approach, though. That's the whole point of the compliance.
The problem at that point was that there was no guidance from OFAC, right? So there was no OFAC guidance on how many hops away was safe. And so they took the strictest approach, which was a number of hops, So yeah, it cuts both ways, unfortunately.
Yeah. Too much information, right?
Too much information is not a good thing either. Yeah. Going back to Tesser, and it's interesting that I want to point out what you said. So the tech stack involves both a non-custodial wallet and the compliance parts that any financial institution needs to implement. So it's a all-in-one stack. Yeah. Is that safe to say?
It is absolutely. I mean, the idea, again, if it was to abstract away all complexity of doing blockchain payments, then they don't have to worry about anything. And so it provides custody piece, which, like I said, could be self-custody. We also integrate with third parties if needed. I mean, we have integrated and we offer that up if needed. We provide embedded on-ramps and off-ramps. So we're integrated with a bunch of on and off-ramps, and we kind of provide the embedded liquidity. They would have to onboard with the on or off ramp. But at the end of the day, the money movement once they're onboarded is all through us. We provide the compliance. We do multi-token, multi-chain. We manage gas. We manage their treasury as well. There are rules and policies around, more USDT is going out today than USDC, but I only have more USDC. How do you swap and kind of keep it, manage your payments? Very focused on payments. And then once the payments are done, the payouts are done, it's like all the reporting, reconciliation, and error handling. And what we've realized is that the reconciliation part, like people just don't even think about it. And then when it comes down to it is when people realize, so let's say you're on the receive side and you're receiving funds from multiple wallets, right? You're an FI, you have a bunch of merchants on the back end, you have a bunch of buyers who are paying these merchants. And you have a bunch of wallets, the funds flow in, you got like $10 from some wallet, it happens to be from a Kraken account, and you have no idea who actually owns that wallet. Like, how do you reconcile this? How do you know who it's supposed to be for? How do you know how it actually came in? Was it Luther sent me the $10? Was it Rami sent me the $10? So we're thinking through a lot of the core reconciliation requirements. As me and my team are all payments nerds, we are really trying to think through how best to get reconciliation to be easily done as part of this process, because we're looking at this as how do you do payments in a scaled manner, right? Everybody can move money from wallet to wallet, like anybody can do that. But how do you actually put the structure on it to do payments in a scaled manner?
Yeah, and that reconciliation has to fit back into the bank's existing systems. That's the tough part.
Exactly.
Right? This is not an institution that just started with your system to begin with. They already had a system that is probably 30 years old that they need to plug this back into.
Yeah, I mean, honestly, a lot of PSPs, they just use Excel. They don't even have a system. They're like, someone calls them, they go, the money didn't make it because you ran out of pre-fund. And then they're like, oh, wait, hold on, let me go update my Excel. So, they could use my system.
Probably our biggest threat vector right there is Excel.
Excel, that's exactly right.
Yeah. We need more lines in Excel. That's what it is.
You're sitting on the front lines of cross-border payments, looking at all the inefficiencies that exist today and how stablecoins are solving for them, Geetha. Thinking outside of Tesser, right? So let's look outside of what Tesser is solving for. But if you look at our industry as a whole and how it's kind of developing, what are some of the headwinds that you see that could slow us down?
I think for the most part, at least today, right? Not looking 10 years into the future, but today, ultimately it is the on and off ramp. Ultimately, it is the building of that endpoint network because, and I think there's a bigger philosophical discussion to be had whether people see a future in which everybody is transacting with stablecoins or stablecoins stay as rails. And I actually tend to believe the latter. I think maybe there'll be certain markets where there's a little more adoption at the, kind of at the POS. But I think in general, I do believe stablecoins are, basically that's what they're there for. They're there to be rails. And if they are going to be rails, at the end of the day, local commerce happens with local currency. So what do you do? Like, how do you get, the funds into the hands of the end user? And to me, that is the biggest, which is why it's both for me a mission and, the business is to get more and more receive side, FIs turned on to be able to do that off ramp and to be so because access to liquidity, it's still extremely fragmented. I can find liquidity providers that charge me 2 bips. I can find liquidity providers that charge me 50 bips. Like, how do I figure out the right ones? How do I onboard my clients in a way that people in the middle make a little bit of margin? So I think on and ultimately liquidity is that is the fundamental thing that needs to be solved. It needs to be solved in a manner that engenders trust in the ecosystem. And that, I think, is the hardest thing to do at this point.
Yeah. The follow-up question to that, this is something that we're seeing now, right? So the Genius Act passed, lots of attention around stablecoins, lots of attention around US stablecoins. But on-chain FX is something that's developing fast. And for on-chain FX, you need non-US stablecoins. Where do you see the growth of non-US stablecoins in this space?
Yeah, I actually did a lot of work on that while I was at Circle. We were trying to actually support other issuers of non-US stablecoins. Circle's actually doing something around like stable FX as well. I do think that the use case that US dollar stablecoins have been serving, for the most part, is quite different from what a non-US stablecoin will serve or will need to serve. I think 2 things. One, for the most part, US dollar stablecoins today have been like stablecoins came up in trading. We all know that. Like, it was really a primary means for traders to move funds in and out quickly. And US dollar stablecoins just made sense for that because it was the most stable instrument. And a lot of cross-border traders, I've heard numbers ranging from 65% to 95%, but a lot of cross-border trade actually happens in US dollars. So that is where that comes to. But I do think what's happening is that ease of transfer at the edges, local jurisdictions, local issuers wanting to get into the game and actually figure out how they can take advantage of the economics, enable different payment systems within their country. That is happening, right? I mean, as you know, like the UAE recently announced a US dollar stablecoin, but prior to that, they have already greenlit multiple AED stablecoins. What they're trying to do is to get the full infrastructure together so that you can trade easily. And I think they're going towards the stable FX model as well. So I do think that this is happening. It's happening for different reasons, but I think that evolution will come together to allow stablecoin FX. I don't think it's the other way around. I don't think, because we need to do stablecoin FX, people are going to get local currency stablecoins. But I think there are reasons to have local stablecoins that, again, I think it will depend on the market. It will depend on the demand. It will depend on the requirement. I don't see, for example, markets like India, Brazil, where they have a very robust local payment system. Stablecoins have to do something different, and I don't know what that is. But in Turkey and in markets where that's not necessarily the case, or there are limitations and very tight frameworks around the local payment systems, I think local stablecoins will actually take over.
Yeah, Turkey is a really good example. I mean, we know the guys at Lira, and they're doing phenomenally well.
Yeah.
Because it's a one-way market. People want to get out of Turkish lira into dollars, and this is the quickest conduit to do that. So it's I know that those guys do a lot of one-way trade. But I think you're right in terms of local stable coins picking up adoption. It doesn't work just because the market itself is crypto-friendly. There needs to be more factors at play. And
there
you're
needs to be a real use case. Yeah.
There needs to be an actual use case. Yeah, and there also needs to be a weakness in the actual current infrastructure. So like PIX or the UPI, in Indian, these systems work already, so there's no requirement for that. But I can see, for example, a Philippine stablecoin potentially could work quite well, or an Indonesian rupiah stablecoin. I can see those, or Malaysian ringgit. These are interesting corridors for remittance, but where the local stablecoin could enhance the velocity of the money and the trading. So, potentially interesting angles there.
In UAE, I mean, the dirham is actually pegged to the dollar, so that was really interesting to me because you don't have so much fluctuation as you would with the Filipino peso or something like that.
Yeah.
Going back to your point, Geetha, around stablecoins being rails, that's really interesting, partly because originally, before people started issuing cards against stablecoins, I would have thought that stablecoin adoption would have been driven by people using stablecoins at point of sales. But now that you see cards being issued, I really feel like the impetus to use the stablecoin itself directly has kind of been taken away by the card. Would you agree with that?
Yeah, I think the card for sure. I think there's a lot of potential for card, but at the same time, card is limited by card acceptance. So, in the sense that, so in the US, I think card acceptance is at like whatever, there's I think 89% penetration or some number like that. In India, it's like 33%. So, there are so many other local forms of payment. So there has to be other ways in which you can off ramp. I guess, Luther, I'm disagreeing with the fact that card is the reason why stablecoin at point of sale will not really take off. I don't know if that's necessarily the case. I think it is. There's not enough of an added value to paying with stablecoins at the point of sale today that I can see. And I think that is the reason why I don't really see that becoming. Now, I think where that could diverge is crypto overall. More and more people start holding wallets, start keeping value in stables, then they want to spend it, and to spend it rather than converting it to fiat before they spend it, easier to spend it as is. My limited vision doesn't see that future anytime soon, so I don't know.
I think though, you raise a good point. There's no material advantage to the consumer in using a stablecoin
exactly
at point of
making,
service.
Yeah.
But there is an incentive for the merchant potentially. I think that's how it needs to be sold, presumably, because if they can make the economics cheaper, if it's but then also we go back in circles, because if they're using a card, then the Visa card's still going to charge the same percentage, even more now, because it's crypto and stable, so they'll charge a premium for this. So I think the economics are a little bit disjointed, and I can't see the incentive for the end customer. It hasn't been sold to the end customer why they should move necessarily to this. If you've got the choice of fiat and you've got a choice of stables, I'm not sure why you'd, unless you get loyalty points or something that can incentivize you to use those stables. Yeah, I agree. I think. Yeah, I'm not sure. What do you think is going to move that needle, though? Because at the moment, if everyone just moves stablecoins into stablecoin cards, that's not solve the problem either. So how do we get people to use, like, is it sort of like the way that QR codes came back in? Like, they started off in Japan and then they became prominent, certainly in COVID. QR code was everything.
So we need another COVID for better stablecoin adoption.
What kind of international disease will it take to make stablecoins?
We need a pandemic.
What kind of pandemic? We need a pandemic. That's what I'm saying.
You ever heard of this thing? It says like new ideas propagate one coffin at a time. So we're saying financial adoption is one pandemic at a time.
That's crazy.
Oh, we don't need to go so aggressive, but what will it take? What will it take to actually move that conversation on? Because I agree with you. Otherwise, we're stuck in the circle for the next couple of years, where actually there's no real advantage. Nothing moves anywhere.
But I think the question is, does it matter? Because I think the efficiency to me is in the movement of money on the back end. Doesn't necessarily have to be at the point of payment. It's the settlement that actually becomes more efficient. And to me, if that's what I think we really are solving for, eventually, if everything is instant, like you're paying, the value moves instantly, settlement at that point is almost, it's a non-thing because you've already paid and they've already got the money, and it really doesn't matter. I just don't know that that's where the value necessarily is. I do think the value is in the back end, the rails. I mean, maybe 30 years down, who knows? But right now, what I'm seeing is that, yeah, we need to make money movement more efficient, not necessarily payments at the point of sale more efficient.
Yeah. And money movement cross-border at a B2B scale is very different value proposition than money movement within a country when you're buying coffee at a coffee shop, right? They're both money movement, but very different. And the value props are very different.
Yeah. Exactly. And all the costs today, the really big costs, the heavy cost structure is in cross-border money movement. So that is what needs to be solved.
As we start to wrap up, Geetha, what are some things about Tesser that people listening to should say, I need to call up Geetha as soon as possible?
If you're an FI and you're thinking about stablecoins, the words even crossed your mind, like, give me a call. let's talk about how you let's talk about, because to be honest, there's still, even though it's in everybody's vernacular, it's still very early. And a lot of the conversations that I have, people are still trying to figure out, what use cases should I be thinking about? How should I be thinking about, implementing this? Like, why would I use a technology provider? Should I use a third-party service? Like, I don't really know what to do. And so there's a lot of education that has to happen. There's a lot of, like, I almost do a good few weeks of consulting before we actually start conversations on what it is that they would need. And I'm helping them think through strategy. So, definitely, I wasn't joking when I said, if you're an FI and if stablecoins in your mind and you're like, I don't know where to start, I'm happy to help. You don't have to buy Tesser. I'm happy to help.
At Stablecoin Partners, we offer advisory services for various companies as well. And some of the questions that we get are, exactly in line like that. They say, should I just open up an account with Circle to begin with? We're like, no, maybe not. Should I just get a wallet from Utila or Fireblocks? Maybe not.
Exactly,
right? So these are valid questions, and there's a lot to think about, especially depending on what your comfort level is, who you plan on hiring, not hiring, how much of this you want to take on, not take on, right? So I completely agree.
Yeah, we certainly live in our own little world, our echo chamber, where we feel that everyone's just as informed as we are. It's certainly not the case. I think when we've sort of sat, and not complete lay people, just literally moving out of our crypto world into traditional finance. And just if you sit in a room of bankers and you ask them about stablecoins and you ask them about money movement, you ask them about wallets and transaction monitoring and this kind of stuff, it's noticeably quick how you lose them straight away. It's still super early. And these are all like, dealing with money movements, dealing with compliance, understanding everything on a fiat basis very, very well. But yeah, I think the education narrative still has a long way to go. Way to go.
Yeah. I'll give you a little mini anecdote. I was at Cybos, and I was invited to a round table with, like, I think there were probably 25 of the largest banks, mostly in and around Europe, and they were all there. And it was run by McKinsey, and they were basically talking about stablecoins and what is the bank's plan to start adopting stablecoins over the next whatever. Everyone made the appropriate noises. Yeah, we're looking into it. Yeah, we're doing something. Yeah, whatever. And it's like, how much money do you have allocated to doing this? And I think the average was like less than $1 million. And it was like, it does not, for a large bank, make any sense. And so, there's still nobody really knows. And then, of course, one bank piped up and said, why should I do stablecoins when I can do tokenized deposits? And that started a whole other interesting conversation.
Yeah, I was going to say, like, Geetha, what are your thoughts on stablecoins versus tokenized deposits?
I don't see the point of tokenized deposits at all. Like, for one, they're completely not interoperable. Like, what are you going to do? Like, if all it was within your bank, you can bloody do that in like an Oracle database ledger. Like, why the heck do you need your own token to do it, just to say that, I have my own token to do it? We know during the days of Silvergate and Signature, if you guys remember those banks, Both of them were they were two of the earliest banks to offer the 24/7. You can move money at any time. One, Signature used a blockchain infrastructure to do it. Silvergate did not. Was there a difference in their service? Absolutely nothing. They both provided the exact same service. One used blockchain. One just used an internal ledger, book, plus minus, book accounting. The service was exactly the same. And if you're going outside, then what is the point of doing something that is not interoperable with anybody else? And if ultimately you're going to find a single coin that works across multiple banks, that's a stablecoin. So I really do not understand the point of tokenized deposits, and that may be just my ignorance, but I have tried to think about it, and I cannot come up with a reason to do it.
Well, the follow-up question is, should every bank that issue their own stablecoin?
No, same thing.
Yeah.
What's the point? I don't get it. Like, why would you do something just for you when it doesn't actually do anything for you that you couldn't already do today, right? So
I do have to think that a bank would ultimately struggle with the decision to, for lack of a better word, put all their eggs in one basket, and that basket being stablecoin issued by some third party that's not even a bank yet.
Yeah.
That's got to be hard.
Yes, that I do agree. I do think, though, that there is a future where these non-bank entities are regulated in a way that you trust them like a bank, and that they do provide the infrastructure, the regulatory oversight, the transparency, all of the things that you need, and that they are a specific class of financial institution that issues stablecoins. And I do think that could be banks as well.
I was going to say they're heading in that direction. I mean, Circle is applying for OCC Bank charter license anyway. So we didn't get into the sort of non-interest paying aspect of why they're going to go down the bank route. But yeah, in terms of being regulated to an appropriate standard and prudential standard so that a bank, another FI can actually interact with their product, I think we're starting to head down that road, now. So, I mean, we had the launch of USAT last week, I think. So this was interesting. That's meant to be, Tether's legitimate onshore regulated quasi product here. So it'd be interesting to see what the take up of that is, and see the adoption. That'll be the proof in the pudding, really.
Yeah, very much.
Geetha, where can people find you?
Geetha@tesser.xyz. I'm on LinkedIn. I'm on Telegram at GPANCHAP. But yes, just call Luther. He'll tell you where.
We'll definitely have all these things listed on our show notes as well. That was a grounded conversation with Geetha Panchapakesan, founder and CEO of Tesser. Cross-border payments may feel slow to change, but stablecoins are forcing a true rethink on how value actually moves globally. If you're building in payments, treasury, or financial infrastructure, this episode offers a clear view of where stablecoins deliver real operational value today. Subscribe and follow the Stablecoin podcast for the latest episode.